Hello everyone, welcome to EduTap and welcome to today's session. So in today's Finance 360-degree session, we are going to discuss a very important notification, a very important press release that is released by the Reserve Bank of India. This is in regards to the directions that is released by the Reserve Bank of India for the digital lending. Okay, so this is very important. I will tell you that what are the important points that you have to remember from these directions. Okay. So RBI has mandated the reporting of digital lending apps via the CIMS portal. And we will discuss that what are the directions that are released by the Reserve Bank of India for the digital lending and the digital lending apps, as well as we will discuss about the most important points that you have to keep in mind from these directions. As the directions are very lengthy, it is around 24 pages, but I will tell you what are the important points that you have to remember. Okay. And I have done a new thing in today's session, so I will show you that what is the new thing that I have brought for you. Okay. So good morning everyone, good morning and welcome to the session. So let's start with today's session, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Now do tell me if I'm clearly audible and visible. I hope there is no problem. Everything is fine, right? Okay. Good morning, everyone. Good morning. And let's start with today's session. So, RBI has issued the Reserve Bank of India Digital Lending Directions 2025. Okay. So, I have told you that whenever the directions or the circulars they are released for the current year, so that becomes important. Specifically, these directions are released just before the examination. You can understand. So, it they are important. These directions are quite important. Okay. So Reserve Bank of India has from time to time issued various directions and circulars on the digital lending by regulated entities. Okay. Now digital lending, I hope you have heard about it, that through the digital platforms the lending has started. Okay. So let's say that you want immediate loan. So instead of going to the banks, instead of filling out the physical forms and so, you can take the loans through the digital platforms, through the digital apps. So the digital lending is becoming more popular in today's day and time. Okay. So RBI has from time to time issued various directions and circulars on the digital lending that is done by the regulated entities, by the banks, NBFCs and such. As part of the efforts to consolidate the various regulatory instructions and streamline the instructions for the digital lending, the RBI has consolidated the directions and the instructions in the Reserve Bank of India Digital Lending Directions 2025. In these directions, all the important guidelines regarding the digital lending has been consolidated. Okay. So now instructions on the following two aspects have been included as part of the directions. So there are two unique instructions that are included in the directions. First of all, instructions on digital lending, transparency in aggregation of loan products from multiple lenders. Let's say that there is a digital lending app, there is a lending service provider. Okay, there is a lending service provider that is connected with a regulated entity. So lending service providers, they are the third parties. Okay, they are the third parties, or that are, let's say, fintech companies or such. So they are the lending service provider that connect with the regulated entities, that connect with the banks, that connect with the NBFCs. Okay. So lending service provider, basically the lending service providers, they are the third parties, they are the fintech companies or such. They connect the regulated entities with the customers. As the lending service providers, through their digital applications, through their digital reach, they try to reach to more and more customers. So many of the regulated entities, let's say bank XYZ, ABC, the NBFCs, so many of the lenders, many of the banks and the NBFCs, they can be connected to a single lending service provider. Okay. And this lending service provider has a digital lending app. So digital lending, in the digital lending, there should be transparency in aggregation of loan products from multiple lenders. That we will see that what are the directions that are released in the digital lending directions. But basically, I hope you have understood the structure, that a lending service provider can be connected with the multiple regulated entities, and these multiple regulated entities, these multiple banks and NBFCs, they are providing the different loan products. So it is said under the directions of the digital lending that the lending service provider should be having transparency when the lending service provider is showing the loan products of the multiple banks and NBFCs to the customers. Okay, so basically lending service provider connect the customers with the multiple banks or NBFCs, and this lending service provider can be connected with the multiple banks and NBFCs, and the lending service provider through the digital lending app is showing the loan products of these multiple banks and NBFCs to the customers. So when the loan products are shown to the customers, so there should be a transparent process that should be followed. So a draft circular was released in this regards in April 26, 2024, and the final instructions on the same are now being included in the digital lending directions that we will understand in today's session, that how the transparency will be followed and such. Okay, so instructions regarding operationalization of the public directory of digital lending apps. So I hope that we have discussed this in a previous session also, that on the statement on developmental and regulatory policy document in that was released on August 8th 2024. In this, it was said that the RBI is thinking of launching a public directory of the digital lending apps, because there were multiple digital lending apps that were originating. So the lending service providers like the fintech companies, they were releasing multiple digital lending apps, and many of the digital lending apps, they were falsely claiming that, let's say I am connected with SBI, State Bank of India. The digital lending apps, they were falsely claiming that they are connected with the important or the prominent banks of the country, but they were actually not connected with the prominent banks of the country. So they were cheating the customers in a way. So due to this, the RBI said that we need a public depository of the digital lending apps that will show that which digital lending apps are actually connected with which regulated entity. Okay, so this was stated in August 8, 2024, that to aid the customers, to help the customers in verifying the claim of digital lending apps. So digital lending apps, they were claiming that they are associated with a regulated entity, with a particular NBFC or bank, while they were actually not related to the banks or NBFCs, let's say. So they were falsely claiming, and the customers had no way to know that are they falsely claiming or not. Okay, so Reserve Bank is creating a public repository of the digital lending apps deployed by the regulated entities, which will be available on the RBI's website. So this was announced that the RBI is thinking of releasing the public depository of the digital lending apps, so that the customers can know that actually with the State Bank of India, which digital lending apps are connected, with the PNB, which digital lending apps are associated. Okay, so it was said that the RBI will be creating this public depository. So the portal shall be so it is said that the regulated entities, they need to put in the details of their digital lending apps through the CIMS portal. So the regulated entities, they are tasked, or they have the responsibility to fill in the details about their digital lending apps in this CIMS. In this CIMS, that is the Centralized Information Management System portal of the RBI. So the portal shall be available to the regulated entities for reporting on or before May 13, 2025, and the regulated entities shall have time till June 15, 2025 to upload the initial data. So regulated entities, they have to fill in the data that which digital lending apps are connected with the regulated entity, and this is the public directory that the RBI is maintaining, but the data has to be fed by the regulated entities. Okay, and it has to be done by June 15, 2025. So this is the basic idea. Any confusion till now? So these directions you are going to understand better in the digital lending directions when we are going to start with it. This is just the basic idea that what all is being included in the directions. Okay, so it may be noted that the list of the digital lending apps is being made available on the website for the limited purpose of aiding the customer. So basically, the digital lending apps, this list, the regulated entities will fill in the data that which digital lending app is connected with this particular regulated entity. So this is to help the customers verify the claim of the digital lending apps, that they are actually connected with the regulated entity or not. Okay, so the list shall be based on the data submitted by the regulated entities. So regulated entities have to submit the data on the CIMS portal of the Reserve Bank of India, and RBI will not do any validation. So it is the responsibility of the regulated entities to fill the correct data. Okay, because if later on any problem comes, the RBI will ask the regulated entities that why the data was wrong and why this has happened. Okay, so they can be penalized and such. So this is the basic idea. Now let's see the directions. So as we have discussed that the RBI has released the Reserve Bank of India digital lending directions. So now the directions were very lengthy, and so I have brought directly the directions for you. So through the RBI's PDF, we are going to discuss the directions. Here I will be telling you that which important points you have to focus on. So usually I bring the points in the PPT, but these directions were very lengthy and there were different points from different areas that are important. Okay, so I've directly brought these directions for you to tell you that what points you have to focus on. So here you can see that RBI has released the digital lending directions 2025 on May 8th, 2025. Okay, so now the directions are quite lengthy and there are multiple things that are discussed in these directions, but you don't have to worry about it. I will tell you the important points that you can focus on. So first of all, just the basic idea that you know that the Reserve Bank of India is at the apex of the banking structure. The RBI is the monetary authority that is at the top of the banking structure. So it is the responsibility of the Reserve Bank of India to help in the operation of the credit system of the country. So RBI encourages the innovation in the financial systems, products, credit delivery methods, so that the customers can get the faster credit, the customers can have the ease of access of the money. Okay, while also focusing on protecting the depositors, protecting the borrowers interest also. So RBI focuses on encouraging the innovation so that the faster credit, the faster loan products, the faster products can be provided to the customers, while keeping in check that the customers are also protected and the depositors are also protected. Okay, now what was happening that the digital lending apps, as they were emerging, there were multiple digital lending apps that were emerging for the customers to take loans from. It is good that the digital lending apps are present, because through the digital lending apps the customers are able to take faster credit, the customers are able to access faster credit from the digital lending apps. Just within a day or 2 days the customers are able to take the loan through the digital lending apps just by providing the details in the online forum, in the online app. Okay, so this is the idea that it is very easy for the customers to take the loans. But what was happening that many of the digital lending apps, they were falsely claiming to be connected to a particular regulated entity which they were not connected to. The digital lending apps, they were also engaged in the breach of data privacy. They were having unfair business conduct because they were falsely claiming to be connected to the regulated entity to which they were not connected with, charging exorbitant interest rates. Because let's say they are not connected with SBI, but they are saying that they are connected with the SBI, but and customers will believe, let's say customers is believing this digital lending app that okay, it is connected with SBI, while it is actually not connected with the SBI. Now the digital lending app is showing that initially they are only taking 2% of the interest rate, which will increased on the monthly basis. Now the customers, they are not reading the documents very carefully, so the digital lending apps were working as a money lender through the online platforms, and they were charging very high interest rates from the customers, as well as they were doing the unethical recovery practices also. So seeing all of these, see the digital lending apps, they are providing the ease for the customer to take the loans, but at the same time they are also engaged in various nefarious activities. So the RBI thought that we need to bring some strict directions for the digital lending. Okay, so that's why the RBI has released the directions here. So these directions shall be called the Reserve Bank of India Digital Lending Directions 2025, and these directions shall come into effect immediately. But the para 6, we will discuss about it. It will come in effect from November 1, 2025, and para 17 will come into effect from June 15, 2025. Okay, so this para is regarding the CIMS. We have discussed this now, that in the CIMS, the reporting that will happen by the regulated entities, in the CIMS, the reporting that will happen by the regulated entities, that shall be done till June 15, 2025. Okay, so this, regarding this, the timeline is provided is June 15, 2025. Okay, so this is the idea. Now applicability. As you know that in the last year examination, there was a direct question about the applicability. So applicability becomes very important. Okay, so these directions shall be applicable to all digital lending activities of the following entities that are the regulated entities. Okay, so all the commercial banks, all the primary urban cooperative banks, state cooperative banks, central cooperative banks, all the non-banking financial companies, including housing finance companies, and all India financial institutions. That is NABARD, NABFID, NHB, EXIM. Okay, so the 5 all India and SEDB. So NABARD, NABFID, NHB, SEDB, and EXIM. So these are the all India financial institutions. So these are the entities on which the directions are applicable at. Now definitions. Definitions are also very important. Any confusion anyone has till now? Now you will see the directions in detail, so everything will be more clear to you. But till now, any confusion? So see, annual percentage rate. Let's understand the definition. So annual percentage rate, this we have discussed when we were discussing the key fact statement. So annual percentage rate is the annual cost of borrowing for the borrower. So it is the annual cost of borrowing for the borrower. So and see, interest rate is considered as the cost for the borrower, but at the same time the borrowers are also paying the legal fees. Let's say they are also paying some extra fees, some document fees or something. So annual percentage rate is the annual cost of borrowing that includes the interest rate that the borrowers will have to pay, as well as it also includes the additional fees that the borrowers have to pay, all the other charges that the borrowers have to pay. So the annual percentage rate, it is the annual cost of borrowing that includes the interest rate that the borrowers have to pay, as well as the other charges that the borrowers have to pay. Okay, so this is the basic idea. I hope this is very much clear. The annual percentage rate, it is not only the interest rate, but it also includes the other charges. Okay, next is default loss guarantee. See, default loss guarantee, you can understand that it is the guarantee that is provided for the default loss. So let's say that XYZ, this person wants to take a loan. This person wants to take a loan from a bank. Okay, now if the person wants to take a loan from the bank, let's say a third party is providing some guarantee to the bank on behalf of this person. So default loss guarantee, this is a contractual arrangement called by whatever name between the regulated entity and the another entity. So the default loss guarantee, this is a contractual arrangement in which the regulated entity is getting a guarantee from the another entity, under which the another entity, that is the third party we can say, this is providing the guarantee to compensate the regulated entity if any default happens. So that is a default loss guarantee. So a third party is providing the guarantee to the regulated entity that if any default happens, a part of the loss will be covered by the third party. Okay, so this is the basic idea of default loss guarantee. This is a contractual arrangement between the regulated entity and the another entity, under which the another entity, the third party, is promising to compensate the regulated entity for the loss due to default up to a certain percentage of the loan portfolio that has been provided by the regulated entity. Okay, so this is the idea. Now, digital lending, all of you know about the digital lending. This is the lending that happens through the digital platforms, through the digital technologies. Okay, so digital lending, through this, the lending service providers that are the fintech companies, let's say, they have launched the digital lending app, and through the digital lending app there is the reach that is done to the customers. So customer acquisition is being done through the digital lending apps, and the credit assessment is done, the loan approval, disbursement, recovery, associated customer service. So digital lending, it includes all of these things, that when the lending is happening through the digital platforms or through the digital process. So when the lending is happening through the digital process or through the digital applications, so this lending is digital lending. Okay, this is the remote automated lending process where the customer acquisition, the disbursement, the approval, the recovery, all of these things are happening on a digital platform and through the digital process. Yes, Aditya, you can say so, that the default loss guarantee, this is the guarantee that is being provided. Okay, and this guarantee can only be provided for a percentage of the loan portfolio. Next is digital lending apps or platforms. So mobile and web-based applications that facilitate the digital lending services. So we are saying that under the digital lending, the customers are acquired through the digital process, the loans are disbursed, the recovery happens through the digital process. But how this digital lending is being done? It is being done through the digital lending apps or digital lending platforms, through the mobile or web-based application that facilitate the digital lending services. Okay, so digital lending apps, they shall include applications of regulated entity. So let me tell you that some NBFCs and the other regulated entities, that we have discussed in the applicability, those were the regulated entities, all the commercial banks, all India financial institutions, NBFCs and such. So these regulated entities, they have their own digital lending apps also. Let's say some NBFCs and the banks, they have their own digital lending apps, while some regulated entities or some NBFCs, they connect with the lending service provider that have the digital lending app. Okay, so this is the basic idea. So DLAs, that is digital lending apps, shall include the application of the regulated entity like the NBFCs or the banks and such, as well as those operated by the lending service provider engaged by regulated entity. So lending service provider, this is the agent of a regulated entity. So lending service provider is usually a fintech company, that is the agent of the regulated entity who carries out one or more regulated entities digital lending functions. Now one lending service provider is not limited to a single regulated entity, it can be connected to multiple regulated entities. Okay, this is the basic idea. So the lending service provider uh, does the customer acquisition through the digital lending applications, through the digital lending platforms, and provides the various services, okay, like the recovery of the loan, monitoring of the loan and such. So this is the basic idea, that the NBFCs or regulated entities can have their own digital lending apps, or the NBFCs or the regulated entities, they can connect with the lending service provider that has a digital lending application, so that the customers can get the loans in a faster manner through the digital lending applications. Now we have completed the definition. Now let's start with the general requirements and the general directions. Okay, I will tell you the important points that you have to focus on. So the data points that you have to focus on, that I will tell you. But here it is just in the initial part, it is just theoretical. The later part is more data oriented. Okay, so due diligence requirements with respect to lending service provider. So whenever the regulated entity is connected with the lending service provider, so there should be a contractual agreement that should happen between the regulated entity and the lending service provider, so that the roles, responsibilities and the rights are clearly defined, that okay, lending service provider should only have this role and this responsibility and this right, it cannot go beyond that. Okay, the regulated entity, whenever it is coming into a contractual agreement with the lending service provider, the regulated entity has to check the past history of the lending service provider. It has to check the technical capabilities of the lending service provider. Do it really have the capacity to reach to more and more customers or not? Why the regulated entity, why the banks and the NBFCs are connecting with the lending service provider? Because lending service provider have the reach to the customers, they have the digital applications that can reach more and more customers. So regulated entity, whenever it is coming in a contract with the lending service provider, regulated entity should check the technical capacity and the capabilities, robustness of data privacy policy, storage system and fairness in conduct and such. The past record has to be checked before coming into the contract. Periodic review of the conduct of the lending service provider should be done. It's not like that once the regulated entity has contracted with a lending service provider, so that's all. No, a regulated entity has to continuously do the periodic review of the conduct of lending service provider. Okay, that it is not cheating or it is not providing wrong information to the customers, because regulated entities through the lending service providers, now they are connecting with more and more customers. So regulated entity has to check the conduct of the lending service provider. Okay, the regulated entity should have a suitable monitoring mechanism for the loans that are provided through the lending service provider. Okay, so these are some of the general directions that you can see, that regulated entity shall impart necessary guidance to lending service providers that are acting as a recovery agent. Okay, so the necessary guidance has to be provided by the regulated entity. So these are some of the basic ideas. Okay, so now regulated entity, the last authority as well as the liability will be with the regulated entity. Even if there is a mistake that is done by the lending service provider, but still the regulated entity will be answerable, that why it has happened, why the regulated entity was not able to check it. So a regulated entity shall remain fully responsible and liable for all the acts, omissions of the lending service provider. So the liability will be with the regulated entity. So regulated entity and LSP arrangements involving multiple lenders. So as we have discussed in these directions, that there can be the lending service provider can provide the loan products of multiple lenders. So in this regards, now we are going to understand the complete directions. Okay, So basically, in case where the lending service provider has agreements with multiple regulated entities. So let's say one lending service provider has connection with multiple regulated entities, with multiple banks, with multiple NBFCs. So in this regard, the LSP shall provide a digital view of on all the loan offers matching the borrower's request. So let's say the borrower has said that I want the personal loan of 1 lakh rupees, and the interest rate I'm ready to pay is up to 14%, and I want the loan for a tenure of 12 months. Let's say the lender A, lender B, lender C, these are the banks. Then there are the NBFCs also, D, E, F. Lender A is saying that, okay, I can provide the personal loan of 1 lakh rupees with the interest rate of 13%. Lender B is saying that I can provide the personal loan of 1 lakh rupees at the interest rate of 12.5% with the tenure of 12 months, Lender C is saying that I can only provide the personal loan of 2 lakh rupees. Lender D is saying I can only provide the personal loan of 2 lakh rupees, and lender E is saying I can provide the personal loan of 1 lakh rupees but with a tenure of 24 months. Lender F is saying I cannot provide personal loan. So you can understand that the LSP is connected with all these lenders, and the LSP will have to show the borrower. The LSP will have to show the borrower the different lenders' products. Okay. So lender A, lender B, lender A and B, only these are the lenders that can provide the borrower with the facility that the borrower wants. So this is the basic idea, that the lending service provider shall provide a digital view of all the loan offers matching the borrower's request on the digital lending app. So it will show that lender A and lender B, they both are agreeing to provide the loan, and they both have the facility that the borrower wants, okay, which meet the requirement of the borrower. The name of the unmatched lenders, so lender C, lender D, E, F, so these were unmatched. Why they were unmatched? Because let's say the C and D, they are only providing the loan of 2 lakh. E and F, they are only providing the loan for 24 months and not for the tenure of 12 months. So that also has to be shown. Okay. So I hope this is very much clear, that the LSP should show the digital view of all the loans that is offering the requirement of the borrower. Okay. Next is, while the LSP may adopt any mechanism to match the request of the borrowers with the lenders to offer a loan, it shall follow a consistent approach for similarly placed borrowers and products. Let's say lender A and lender B, they are both providing the personal loan of 1 lakh rupees, but they have lender A is providing at 13%, lender B is providing at 12.5%. Okay, so whichever borrower is providing the whichever lender is providing the requirement of the borrower had the requirement of the loan of 1 lakh rupees with the percentage of up to 14%. So the LSP should show all the lenders that are providing such requirements. Okay, digital view of loan offers from matching lenders shall include the name of the regulated entity. Let's say this is SBI, this is Punjab National Bank. The amount, the tenure, the timeline, all has to be shown. The penal charges has to be shown. The repayment obligation has to be shown, and the content displayed by the LSP shall be unbiased, objective, shall not directly and indirectly promote or push a product of a particular regulated entity. Let's say that I'm a lending service provider and I'm pushing the lender B. Is it wrong to push lender B? Lender B is providing the loan at 12.5%. So is it wrong to push the lender B? It is wrong to push the lender B, but because what if the penal charges are very high of the lender B? What if the lender B has some hidden clauses? What if the lender B has some higher charges for taking out the money or repaying before the timeline? So you can understand that the borrower should be given the choice that, okay, these two are meeting your requirements. You can see the rest of the information about the repayment obligation, about the penal charges, and after seeing the rest of the things, then you can decide. So I hope you are able to understand the point, that which the lending service provider has to show all the lenders that are near to the that are meeting the requirement of the borrowers, or that are not meeting the requirement of the borrowers. The lenders that are meeting the requirement of the borrowers, let's say 5 lenders are meeting the requirement of the borrower, so all those 5 lenders has to be shown to the borrowers, then the borrower will make the choice. Okay. Okay, conduct and customer protection requirements. So this is basic that the customer protection has to be done. Okay, there should be no automatic increase in the credit limit. Only the necessary information should be obtained from the borrower. Okay. Next is disclosure to the borrowers. So regulated entity shall provide a key fact statement. I hope many of you know about the key fact statement. It includes all the details about the loan in a page or 2 pages. So key fact statement, it includes the annual uh, cost of borrowing. That is, it includes the APR. It includes the repayment like repayment obligation and the penal charges and all. Okay, so this is the basic idea. Now regulated entities shall maintain a website of their own in public domain, which shall be kept up to date, and it should include the details of all its digital lending products and its DLS. Okay, so the regulated entity should shall maintain a website of their own in public domain that includes the details of all the digital lending products and its DLS. So in the website of the regulated entity, there should be the mention of the digital lending products of the regulated entity, personal loan, home loan, car loan, whatever it is. So it has to be mentioned in the website of the regulated entity, and all the digital lending apps should also be mentioned. Okay, so this is the basic idea that the RBI, the regulated entity website, the website of the regulated entity, the website of the bank or the NBFC or such, they should have the link to the CMS portal of the RBI. CMS portal is the complaint management system portal of the RBI, through which you can raise your complaints also. Such a portal also, this is the portal through which the people can raise their complaints. Okay, so this is the basic idea. Now the next point is that in case of a loan default, when a recovery agent is assigned for recovery, so the customer or the borrower has to be informed about the recovery agent, and the details of the recovery agent has to be sent to the borrower. So let's say the borrower has not given the loan, let's say it has been 30 days overdue. So the bank is sending a recovery agent to the borrower. So the borrower has to be informed about it. Okay, so the particulars of such recovery agent should be communicated to the borrower through email or SMS. Now loan disbursal, servicing and repayment. So first of all, loan disbursal should directly happen to the borrower's account. If the repayment is happening of the loan, that should directly happen to the regulated entity's account. That means the bank is giving loan to the borrower, so the loan should directly go to the borrower's account. It's not like that the bank is sending the loan to the lending service provider, then the lending service provider is sending the money to the borrower. No, the lending service provider should not be engaged in the money terms. Okay, so bank should directly send the money to the borrower's account, and borrower should directly repay in the account of the bank. That's the simple idea. Okay, so lending service provider should not be engaged in the transactions of the money, as well as the lending service provider, whatever charges are there of the lending service provider, it should be taken directly from the bank or the regulated entity. The people or the customer or the borrower should not be asked for money by the lending service provider, because the regulated entity is taking the service of the lending service provider. So regulated entity should pay to the lending service provider. Okay, in case of delinquent loans, that means in case of the overdue, regulated entity may deploy physical interface to recover loans. That is, recovery agent can be hired or recovery agent can be sent. But the recovery that is happening in cash, let's say the person has some money, let's say has 10,000 rupees currently. So person is giving 10,000 rupees to the recovery agent. Okay, so any recovery by cash shall be duly reflected in full in the borrower's account on the same day, and regulated entity shall ensure that any fees, charges, etc. payable to the LSPs for such recovery are paid directly by the regulated entity. So this is the basic idea. Okay, so in case of delinquent loans, regulated entity may deploy physical interface to recover the loans in cash wherever necessary, and however any recovery by cash shall be duly reflected in the borrower's account on the same day, and from the borrower's account then the money will go to the bank. Simply, this is the idea. Now cooling off period, this is important. So I will mark all the things that are important. This is very much important. Okay, till now any confusion, anyone? Till now any confusion? All clear? Okay, so the borrower shall be given an explicit option to exit a digital loan. So let's say that you have just got a loan, but the next day you realize that okay, you have got the money from your parents, or you have got the money from your siblings, or you have got the money from your relatives, so now you do not require the loan. So there should be a cooling off period that should be provided. So the borrower shall be given an explicit option to exit a digital loan by paying the principal and the proportionate annual rate, okay, the annual cost or the interest rate and the charges, without any penalty during an initial cooling off period. So there is a cooling off period. Some banks can have the cooling off period of 2 days for the digital loans. Some banks can have the cooling off period of 1 week or 3 days or such. So there should be a cooling off period for the customers. In the cooling off period, for the repayment of the loans, there should be no extra penalty that has to be paid, okay. And as per the RBI norms, there should be the cooling off period of not less than 1 day. At least 1 day should be given as a cooling off period, okay. So the cooling off period cannot be less than 1 day. This is the idea. And in the cooling off period, there is no penalty for the repayment. There is no penalty of paying back the loan, but the regulated entities, they can charge a reasonable one-time processing fee for repayment, but there cannot be any penalty. Now, grievance redressal, as you know, that the regulated entity should have a grievance redressal system, so that let's say you have a complaint against the bank, you have a complaint against the NBFC, so you can ask or you can file your complaint with the regulated entity. So the banks, NBFCs and all the other regulated entities, they should have a grievance redressal system. Similarly, now the LSP, that is the lending service provider, should also have the grievance redressal officers, so that the grievances of the customers can be handled, okay. So this is the basic idea. If any complaint is lodged by the borrower against the regulated entity or the lending service provider that is engaged with this regulated entity, and let's say the regulated entity has rejected the complaint wholly or partially, the borrower is not satisfied with the answer, or the borrower has not received the reply within 30 days of the receipt of the complaint by the regulated entity. So let's say the borrower has not got the reply from the regulated entity or from the lending service provider within 30 days of raising the complaint, then the borrower can go to the complaint management system of the Reserve Bank of India, or the borrower can go to the Reserve Bank Integrated Ombudsman Scheme through the, or can send the physical complaint to the centralized receipt and processing center, okay. So basically, the lending service provider and the regulated entity, they should have the interface with the borrower, where the borrower can raise the grievances or the complaints, okay. But let's say the bank is not answering, or the lending service provider is not resolving the problem, so then the if the borrower is not getting the reply within 30 days, or the reply is not satisfactory, then the borrower can go to the complaint management system portal of the RBI or the Reserve Bank Integrated Ombudsman Scheme, or the complaint can be sent to the centralized receipt and processing center, okay. Next is collection and usage and sharing of data with third parties. So of course, it is said that the digital lending apps, they can only store, or they can only have the need based data, and that also with the explicit consent of the borrower. So extra data cannot be stored by the digital lending apps. The biometric data cannot be stored, or biometric data cannot be kept with the digital lending apps or the lending service providers, okay. So basically, only very important data, very necessary data, need based data can be taken by the digital lending apps, like the name, the KYC details and such, okay. The extra data cannot be taken by the digital lending apps. The borrower shall be provided with an option to give or deny the consent for use of specific data, as well as explicit consent has to be taken before taking the personal data, okay, or before sharing the personal information with any third party. Storage of data. So regulated entity shall ensure that the lending service provider engaged by them do not store personal information of the borrower except some minimal basic information about the age, name, contact details, that's it, okay. The extra information should not be stored with the lending service provider at any cost. Regulated entity shall ensure that no biometric data is stored or collected by the regulated entity or the lending service provider. All the data that is stored only in servers located within India. So regulated entity shall ensure that all the data that is stored regarding the name, age, contact number, that also stored in India only. If let's say there is some data that is processed outside India, so the same shall be deleted from the servers outside India and brought back to India within 24 hours of processing. So first of all the data should be stored in India, in the servers of India. If any data is processed outside India, so that should be brought back within India for within 24 hours. So this is the basic idea. Privacy policy is very important, that the lending service providers and the regulated entities, they have to like take care of the privacy of the people. And so first of all, they cannot take some extra data. They cannot take the call details or the call logs of the people. They cannot have the extra details of the people. They can only have the basic information about the people that can be taken during the loans. Okay, so this is the idea. Now reporting to the credit information companies. So regulated entities shall ensure that any lending done through their digital lending apps, or any lending that is done through the digital lending apps of the lending service provider, is reported by them, by the regulated entity, to the credit information companies, irrespective of its nature or tenure. Okay, reporting of DLS to RBI. So digital lending apps has to be reported to the RBI. Now this is the 17th point. That means from July 2025, the reporting of the digital lending apps should happen to the RBI. This is regarding the repository. Now there is a question to you, that the regulated entities have to provide the data regarding the digital lending apps to the RBI through which portal? Through which portal? Is it the CMS portal, CIMS portal, Sachet portal, the Prava portal, or through any other portal? Through the Daksh portal, let's say. So through which portal? Through which portal the regulated entities have to provide the information about the digital lending apps that they are connected with to the RBI? So through which portal this information will be provided to the RBI? Through which portal? We have discussed this. Regulated entity shall report all the digital lending apps deployed or joined by them. So regulated entity is connected with the DLA. Let's say regulated entity has launched a DLA. Or let's say the regulated entity is connected with the lending service provider. Through that, it is taking the services of the digital lending app. So regulated entity shall report all the digital lending apps that is deployed by itself or joined by them, whether their own or those of the LSP. So if regulated entity is connected with the digital lending app of the lending service provider, so that has to be informed. Regulated entity has its own digital lending app that has to be informed on the centralized information management system portal of RBI. Very good, everyone. So this is the basic idea. Okay, and this regulated entity shall ensure the correctness and the timelines of information regarding the digital lending apps that has to be submitted by the regulated entity on the CIMS. RBI will not verify or validate the details. The data should be submitted by the regulated entities, and it should be absolutely correct, and the data shall be submitted. So a regulated entity shall ensure that the reporting in respect of all the digital lending apps on the CIMS portal is completed by June 15th, 2025. Okay, so this is the basic idea. Now eligibility. Now coming to a very important next point, that is the default loss guarantee. So now this is the last point that we have to discuss in today's session, default loss guarantee. Okay, so in the case of default loss guarantee, regulated entities may enter into default loss guarantee arrangements only with the lending service provider or other regulated entity that is engaged as a lending service provider. Clear? So regulated entity can have the default loss guarantee, only from the lending service provider or from the regulated entity that is working as a lending service provider. So usually the lending service provider are the fintech companies, but some NBFCs can also work as lending service provider. So such regulated entity that is working as the lending service provider, that can provide the default loss guarantee. Okay, so who can provide the default loss guarantee? This is the first and the foremost question, that who can provide the default loss guarantee. So who can provide the default loss guarantee? The regulated entity that is working as the lending service provider, or the lending service provider, that is some fintech company or some, they can provide the default loss guarantee to regulated entity. Now lending service provider providing the default loss guarantee shall be incorporated as a company under Companies Act of 2013. Okay, now due diligence and other requirements. So whenever the default loss guarantee is being provided, there should be due diligence that should happen. So whenever the contracts are being signed, so that should be duly and prudently checked. So this is the basic idea that you can see. Now coming to the important points, restrictions on entering into default loss guarantee arrangements. So there are some restrictions. Regulated entity shall not enter into the default loss guarantee arrangement for revolving credit facilities. For revolving credit facilities, let's say that in your account you have the revolving credit facility of 1 lakh rupees. You have taken out 50,000 as a credit. Now you have paid back the 50,000. So, or let's say you have taken out 60,000. You have taken out 60,000. You are left with 40,000. Okay. Now you have paid back 10,000. So now you can get the loan of 50,000. Let's say you have paid back 20,000 more. So now you have the credit facility of 70,000. Okay. So this is the revolving credit facility. You keep on taking the loans, you keep on paying back. Okay. So regulated entity shall not enter into the default loss guarantee arrangements for revolving credit facilities offered through digital lending channel and credit cards. This is the basic idea. Now next is regulated entity shall not enter into the default loss guarantee arrangement on the loans which are covered by the credit guarantee schemes. So regulated entities shall not enter into the default loss guarantee arrangements on the loans that are guaranteed, that are covered under the credit guarantee scheme. That this point we will further discuss in the coming pages. So NBFC peer-to-peer. So you know that there are NBFC peer-to-peer lending platforms in which the people like you and me, let's say we have money, so we can become the lenders, and the people like you and me, let's say we do not have the money, so we are becoming the borrowers. So the person to person, this is the NBFC peer to peer lending platform. So this NBFC creates a platform where the people can come as the lenders that have the money, and the people that do not have the money, they come as the borrowers and they do the transaction among themselves. Okay. So NBFC peer to peer shall not enter into the default loss guarantee arrangements for the loans facilitated over its own platform. Okay. So the NBFC peer to peer, now you know that this is the regulated entity. NBFC is a regulated entity. So it can work as a lending service provider. It can provide the default loss guarantee also, but it cannot provide the default loss guarantee for the loans facilitated over its own platform. This is the basic idea. Now the structure of the DLG arrangements. So the DLG arrangement, no, here it is not written that own LSP. It is written that regulated entity may enter into DLG arrangements only with the LSP, with any LSP, with any lending service provider in the country. Okay, this is the idea. Now DLG arrangements. DLG arrangements shall be backed by an explicit and legally enforceable contract. So basically, if the regulated entity and the lending service provider, they are coming into a contract of the digital lending, default loss guarantee. So lending service provider is providing default loss guarantee. So there should be an enforceable contract that should be signed, and it should include the extent of the cover that is provided under the default loss guarantee, form in which DLG cover is to be maintained with the regulated entity that we are going to discuss. Then timeline for the DLG invocation. That means, let's say 90 days has happened in which the borrower has not returned the money, or there is the overdue for 90 days, there is the overdue for 30 days. So what is the timeline in which the default loss guarantee will be invoked and the LSP will have to pay to the regulated entity? So all of this. Forms of DLG, that means regulated entity shall accept default loss guarantee only in one or the more of the following forms. The cash deposited with the regulated entity. So let's say lending service provider is giving a default loss guarantee to the regulated entity. So this guarantee is provided by the LSP. But can we trust LSP? Can we trust a fintech company? So LSP can be only trusted if the LSP is providing cash deposit with the regulated entity for the guarantee. Okay. A fixed deposit maintained with a scheduled commercial bank with a linear marked in favor of the regulated entity. That means that if the default happens, so LSP, the lending service provider, let's say it has a fixed deposit with the scheduled commercial bank. So the LSP has signed a default loss guarantee with the regulated entity. So the LSP also has a fixed deposit. So now the LSP is providing this fixed deposit as a guarantee to the regulated entity. So fixed deposit that is maintained by the LSP with any of the scheduled commercial bank, it should be marked in favor of the regulated entity for the guarantee to cover the default if the loss happens. Bank guarantee in favor of the regulated entity. So the LSP can have a bank guarantee for the default loss coverage for the regulated entity. Okay, so these are the forms of the DLG. You need to only have the basic idea of the forms of the DLG. Now cap on DLG, this is very important. Now this is the one of the most important points. After this, I think it will be done. It will be finished. So regulated entity shall ensure that the total amount of DLG cover on any outstanding portfolio. So basically, the default loss guarantee should not exceed 5% of the total amount disbursed out of the loan portfolio at any given time. So basically, let's take the example. Let's take the easy example. Assume that out of the let's say loans amounting to 10 crore has been disbursed. So 10 crore of loan has been disbursed immediately. Then as on April 1, 2024, the DLG cover available for the portfolio shall be, like it is said that the DLG cover cannot be more than 5%, right? The DLG cover cannot be more than 5%. So let's say that the DLG cover that is provided on the loan of 10 crore is 5%. So that is 0.5 crore. This much is the DLG cover. This much is the DLG cover. See, why the DLG cover is kept as only up to 5%? Because it is said that the regulated entity should be responsible for the loans that it is providing. If let's say DLG cover is very high, the default loss guarantee cover is very high that the LSP is providing. So in this case, what happens that the regulated entities may become complacent that okay, we have the default loss guarantee. Why should we be afraid? If the default happens, the lending service provider will cater to it. So this mindset should not be there. If the regulated entity is providing a loan, it should be prudent loan, a good loan that should be provided with all the checks that the regulated entity should do. So it is said that the default loss guarantee can be up to 5% only. Okay, so this is the idea. So default loss guarantee can be up to 5% only. So here 5% of 0.5%. Okay. Now let's say subsequently if more loans of 10 crore is given. So now more loans of 10 crore is given. So on this it will be 5%. That is 0.5 crore. Okay. So this is the default loss guarantee on this additional 10 crore. So in total the default loss guarantee is of 1 crore now. In total the default loss guarantee is of 1 crore now. I hope this is clear, right? Any confusion? Any confusion, anyone? So here also you can see that the loan portfolio was of is of 40 crores. The loan portfolio is of 40 crores that is disbursed. See, one in the loan case there are two terms. Sanctioned loan. Sanctioned loan means let's say I have promised you to give the loan of 100 crores. But out of this 100 crores, only 40 crores is disbursed. So actually the loan portfolio or the loan that is disbursed, on this, the default loss guarantee of let's say up to 5% can be taken. So sanction loan is the loan which has been approved by the authority, but still there is some still the loan is not disbursed. It is only approved. The paperwork has happened. Okay, so this is a sanction loan. But here we are not talking about the DLG on the sanction loan. We are talking about the default loss guarantee on the disbursed loan. Okay, so that's why here it is mentioned that the disbursed loan is 40 crore. So on that, let's say 5% is the default loss guarantee. That means 2 crore is the default loss guarantee. Okay, so let me give you an example that let's say the regulated entity is connected with the lending service provider XYZ. Now the lending service provider through the digital lending application, it is providing the loan portfolio of 40 crores. Okay, regulated entity is asked to clear this loan. So regulated entity will do the due diligence, will see that okay, the customers that want to take the loan are fine. So there are let's say 20 customers that in total, let's say one customer is taking 1 crore, some customer is taking 2 crore, some customer is taking let's say 10 lakh rupees, or let's say there are 100 customers that are taking 40 crores rupees in total. So this is the total loan portfolio. Okay, so the regulated entity has done the due diligence and the regulated entity has thought to release this money to the borrowers. So the lending service provider here is giving the default loss guarantee of let's say 5%, because up to 5% only the default loss guarantee can be given. So this is the basic idea. I hope this is very much clear that the regulated entities, they are connected with the lending service provider and they can take the default loss guarantee from their own lending service provider or from the other lending service providers also. Okay, so this is the idea. So default loss guarantee we have discussed, it can be up to 5% only. So the default loss guarantee cover on any outstanding portfolio, that means on the disbursed portfolio, shall not exceed 5% of the total amount of the disbursed portfolio. Okay, so basically the default loss guarantee cannot exceed 5% of the disbursed amount. So this is the idea. If the money is not coming back, or if the, let's say, 40 crores has been given through the lending service provider, but let's say 20 crore is not coming back by the 50 of the borrowers, 20 crore is not coming back, so it should be taken as a non-performing asset. Okay. Next is the invocation and tenure of the DLG. So the default loss guarantee has to be invoked or has to be taken if the default happens. But within how many days should the default be considered, or within how many days the DLG should be invoked? So regulated entity shall invoke the DLG within a maximum overdue period of 120 days. Okay, so this is the basic idea, that regulated entity shall invoke DLG within a maximum overdue period of 120 days. That means if the money has not been paid for by the borrower, if the money has not been paid by the borrower, if the EMIs, if the interest payments have not been made by the borrowers, so within 120 days, within maximum of 120 days, the regulated entity shall invoke the DLG. The regulated entity can invoke the DLG within 30 days of the overdue, or 90 days of overdue, or 60 days of overdue, but the regulated entity shall invoke the DLG within a maximum overdue period of 120 days. That is the basic idea. Okay. Now the next is that regulated entity shall ensure shall put in place a mechanism to ensure that the LSPs with whom they have a DLG arrangement shall publish on their website the total number of portfolios and the respective amount of each portfolio on which DLG has been offered. So basically LSP in its own website should be showcasing that how many DLGs it has given for how many loan, for how much of the loan portfolio. LSPs give the DLG because they also get some fees from the borrowers. Okay, so this is the basic idea, that the regulated entity shall put in place a mechanism to ensure that the lending service providers with whom they have the default loss guarantee, so they publish the default loss guarantee in their own website. Okay, so that all the other regulated entities are aware about that how much default loss guarantee they have already given. Have they given too much of the default loss guarantee already? Okay, and disclosure under the para 1 shall be made on a monthly basis. So lending service providers on the monthly basis has to disclose the default loss guarantee that they have provided, and the regulated entity has to keep this in check. Okay, with a disclosure for any given month to be provided no later than 7 working days. So as soon as May finishes, so within 7 working days for the May month, the default loss guarantee has to be released. Okay, now exceptions. So guarantee schemes of credit, guarantee fund, trust for micro and small enterprises, they are, so guarantees covered under the following schemes or entities shall not be covered within the definition of DLG. So these are the guarantees. Okay, just the names you have to read. So general provisions, so EMI programs on credit card are governed specially under this, that the card issuer shall ensure complete transparency in the conversion of credit card transactions to the EMIs. So let's say the card issuer, that is a bank, has issued a credit card, and now the person is not able to repay the payments for the credit card. So this credit card payments are turned into the loan, and the EMIs has to be paid by the person. Okay, so this is the process that is followed for the credit card. So such transactions that comes under the credit card, they shall not be covered under the default loss guarantee directions or under the digital lending directions. Under the digital lending directions, they should not be included. Okay. However, the other loan products offered on the credit cards, like additional loan products that are offered on the credit cards, they can come under the digital lending guidelines. Okay, this is the idea. So this is it for today, and these are just the repeal provisions. So these provisions have been repealed, but you don't have to focus on that. So I have covered the directions, I have covered the overall directions. I knew that these directions are important. Some points are very, very important, especially the data points are very, very important, so that you had to focus on. Okay, and see, the I have shown you the whole PDF of the directions that the RBI has released. Usually I bring it in the PPT, but if I would have brought it in the PPT, I would have missed many of the points. And then when you go through the PDF, you might have been confused in some of the points. That's why I have directly brought the PDF this time. If you enjoyed it, do tell me. If you want it in the PPT itself, do tell me that also. Okay. So this is the first question. I hope you will be easily able to answer this question. And this is the second question. This is the second question that you can read and you can answer. Okay. Any confusion anyone has in today's session? Any confusion anyone? Okay, so I'm getting the question that revolving credit. Revolving credit, as I have explained you, that revolving credit is a kind of, let's say revolving credit has a limit of 1 lakh. Okay. Now in this limit, you can take the loan. Let's say you have taken the loan of 90,000. So 10,000 is left. Now out of the loan that you have taken of 90,000, you have repaid 50,000. So that means in the limit of 1 lakh, 10,000 was left. Now you have repaid 50,000. So you can take the loan of 60,000 now. Okay. So this is revolving credit. Revolving credit within a set limit. Okay. Revolving credit is a type of credit where you can borrow, repay, and borrow again within a set credit limit. So within a set credit limit, you can borrow, you can repay, you can borrow again within a set credit limit. This is the revolving credit. Okay. Any other confusion, anyone? I will send you the highlighted one, but I don't think the annotation should be sent because it will make you confused. I will send you the highlighted ones. Okay. Okay, then thank you everyone. Thank you for joining the session. See you in the next session. Thank you everyone. So do give me the right answer of the two questions. Okay.